Hi, I'm Sharon Winsmith, a tax attorney, active investor, and your go-to resource for proven investment and tax planning strategies. Before you start the video, please go ahead and like the video because that helps me really grow my channel and get my content out there. In this video, I'm going to talk to you about why if you have excess cash on hand, you should hesitate before paying down your mortgage. I'm going to explain to you how to think about the opportunity costs when it comes to paying off debt as opposed to investing excess money. I want to caution at the beginning that this video is really only for sophisticated investors who are very disciplined. If you are someone who has a lot of bad debt, like credit card debt, student loans, things like that, or you're someone who really can't control your spending habits, then this is not the video for you and you could get yourself in a lot of trouble. So I'm going to explain a situation where if you have a fact pattern where your mortgage on your home is at a very low interest rate, like 3, 4, 5% even in some cases, but you were able to invest money in a way that you can get returns in excess of that interest rate on your mortgage, how you want to consider maybe not paying off more than you need to each month and instead investing that excess cash. So the reason I think this video is very important is that a lot of people out there, more outdated thinkers like Dave Ramsey would tell you, make double, triple mortgage payments if you can each month, pay off that mortgage as soon as possible. I know with our grandparents' generation that one of the best days of their lives was when they paid off their mortgage and they owned their house outright. That actually, in my opinion, is very poor planning. I don't really know why anyone would want to pay off their mortgage. If you can have the ability to borrow against your home and invest in a way that you are making better returns than you would have by paying off that debt, then it makes no sense to really pay that down. Again, this is assuming that you're a disciplined investor and really understand how opportunity cost works when it comes to investing. So the point, again, I'm trying to illustrate is that when you are building wealth, you need to think about opportunity cost and how you can put your money to the best use possible. How can you maximize the returns that you get on that money and invest it and use it in a way that you're going to increase your wealth in the most efficient way possible without taking on too much bad risk. Before I start, I'm going to walk you through an example of how this would work in practice, but this strategy only works if the interest on your mortgage is lower than the investment returns. So if you're someone that for some reason has a really high interest rate, like 7, 8%, this strategy is not going to work for you until you can do a refinance and get a lower interest rate. You need to have a situation where you can invest your money in a way that you're very comfortable on average. Those returns are going to exceed the interest rate that you have to pay on your mortgage. And when I walk you through the example, you'll understand why that's the case a little bit more. The other thing I want to mention is that there are other reasons why it might be beneficial not to pay down a mortgage. For example, having a mortgage or having debt on anything provides asset protection because that makes you an unattractive litigant, and it means anyone suing you trying to come after your money or your home, they have to get in line behind the bank, which no one wants to be in line behind the bank because the bank or the lender on that asset, which in this case is your home, is always going to become first in line. So let's dive right into an example of how this would work in practice. So in this fact pattern, I've assumed that we've bought a home worth $1 million. I think that's a pretty reasonable amount for our personal residence. If you live in New York City like I do and you buy a home, then you're probably going to pay a lot more than that. But in other parts of the country, you can probably, get a decent sized home for that amount. So just to make it simple, value of the home is $1 million. We took out a mortgage of $800,000 and put 20% down of $200,000. So I always like to put the least amount down as possible when I can get a low interest rate. You always should be able to get a low interest rate on mortgages. If right now when I'm recording this video, interest rates are quite high, so it would not be the time to buy a home and or refinance your house. You would want to wait until interest rates are lower. But most people have a good interest rate, on their mortgage. 3, 4% range is a really good rate to lock in there for a mortgage. I know, a year or so ago, you could actually sometimes even get rates better than that. So I'm going to assume an interest rate of 3.5% on the mortgage. And I think that that's a pretty, reasonable amount and pretty average based on, what a lot of people have. I'm going to assume a 30-year term because I like, longest term as possible. And again, I'm not talking about that you don't have to make those monthly mortgage principal and interest payments. You do have to pay those. If you don't pay those, you're going to kill your credit score and have a really bad situation. So you've got to pay those monthly payments that are required. In this case, you're going to pay principal of $26,667, and you're going to pay interest of $28,000. So that's every year you've got to pay that over to the bank. That's a total of $54,666. That is your annual mortgage payment when this is your fact pattern and these are the terms of your mortgage. So for my example, I'm going to assume that I could get investment return of 8% on average. This is a pretty, I think, very reasonable return to expect. If you were just investing in something like an S&P 500 index fund, this would be a pretty good return average that you could expect from that investment. I know, if you're getting lower than that, you might want to think about, your investment strategy and if you're doing everything right there, because in my opinion, 8% should be pretty easy to get on average every year. I get a lot higher than that. Again, without taking on unnecessarily crazy risk. So this is the investment return that you could get. This is your interest rate. These two are going to become important because I'm going to show you why investing money and getting investment returns of 8% every year is better than paying down a mortgage or debt where you have 3.5 interest on that debt. To finalize this fact pattern, I want to assume that you have excess money every year of $50,000. So after you pay all your expenses, pay everything else, and make your mortgage payment to the bank, you've got an extra $50,000 cash on hand. So you can either listen to Dave Ramsey and use that $50,000 to pay down your principal on your mortgage and get rid of that sooner, or you can listen to me and do option 2 that I'll walk you through, where you invest that $50,000 and just keep making the mortgage payments that you're required to make, but nothing above that. So I'm going to walk you through those two options that I just discussed, and I'm going to show you why you're better off doing the latter, assuming that you don't invest in something dumb that's going to, make you lose your money. Yes, there is risk here. With everything comes risk. So some people would say that, if you pay off your mortgage, that's risk-free because you're paying off debt with cash. However, I disagree with that view of risk. I think that's a very, untraditional view, a very traditional view of risk and a little bit outdated. I think paying off debt where you have 3.5 interest is one of the more risky things that you can do if you're a very savvy and sophisticated investor. So again, this only works if you can get, 8% or higher than 3.5% returns on your investment, this money that you're going to invest every year. On average, if you can exceed that. So we're looking at the opportunity cost. We're looking at the arbitrage between those two numbers, those two interest rates, and how we can maximize our wealth by using that money, that extra $50,000 we have each year, by putting it to its best use. So let's just run through really quickly how this would look in practice. So let's say option 1, you listen to Dave Ramsey and you pay down that mortgage. So I've hidden some of the cells so that just is easier to look at, but you're going year 0 through 10. Here, I've got my outstanding mortgage of $800,000 starting, January 1st of 2023 when I took out the mortgage. I have to pay this principal every year. I've got to pay this no matter what. You're required to pay off that principal amount every year. And I've got, an extra $50,000 that I mentioned. So I'm going to listen to Dave Ramsey. I'm going to pay down my mortgage balance. So my mortgage balance at the end of year 1 is $723,000. When I keep repeating this out, year 2, it's $646,000, all the way to year 10 when I have paid off my mortgage. So pop the champagne, the bank's going to send you balloons and say, congratulations, you own this house outright. What does my net worth situation look at that point? So I own my home clear and outright. The equity in my home is $1 million. So I'm going to say that I have a $1 million asset there. I think it's debatable whether or not your home is an asset. I personally think it's not, but for purposes of this example, I'm going to show you've got $1 million of equity in your home that, because you've paid off your full mortgage, you own it outright. Other assets, I got a little bit of other assets. I got cash of $43,000 because I didn't need the full $50,000 to pay it off in year 10. I only needed $6,000 to pay off the rest of that mortgage. So I've got an extra $43,000 that now I can do whatever I want with that because I don't have to make any more mortgage payments to the bank. So my total net worth in year 10, once I've paid off my mortgage, is $1,043,000. So that might sound great. Like, yeah, I own my home. I'm a millionaire. This is a terrible balance sheet, by the way, if this is your balance sheet. But let's say, you're a millionaire, you paid off your home, and that's the result at the end of year 1. So you might think that's great, but I'm going to show you why you would have been better off if you hadn't paid down that mortgage and used that $50,000 to pay off the principal, but instead invested that money in a way that you get 8% returns. So let's look at option 2, which is the way I would do this because I'm comfortable that I can invest my money in a way I'm not taking on a lot of risk, if really, any material risk at all, and get 8% returns. So This is a great strategy for someone like myself who's a very disciplined investor and understands how this works and understands the risk I'm taking on by doing this strategy. So what's different from option one here is that I'm looking here instead of my principal pay down on my mortgage, I'm looking at my investment. So this is investments outside of your home. Your home is not an investment. It 100% is not ever an investment. So your beginning investment here is zero, and your annual gain is zero because you didn't have any investments to earn any returns on. But when I come December 31st, at the end of the year, I've got an extra $50,000 that I can invest. So my investment value at the end of year one is $50,000. So when I start the next year, 2024, I've got $50,000 that I'm investing from day one. I get 8% return on that. So I've made $4,000 in that year. And again, I've got another $50,000 at the year end that I can put into that investment. If it's an index fund, for example, I'm putting another $50,000 in there. And so now at the end of year 2024, I've got $104,000 of investments on hand. Remember, if I were in option one, I don't have any investments. My investments are still zero because I was paying off that mortgage payment principal. I was not investing that money. So again, this plays all the way out. We're going to go all the way out to year 10. Here, because of the beauty of compounding, my beginning value of my investment, whatever that investment is, I'm going to assume it's like an S&P 500 index fund. My value is $724,328. So that is, a great situation to have. You can really see why compounding really is magical. It really is a great thing. And again, my annual gain now, I'm making almost $60,000 a year on my investment. And again, I can put another $50,000 in because I didn't make any excess mortgage principal paydowns. So when all is said and done at the end of year 10 in 2033, I've got an investment worth $832,274. That is an investment that I have doing this strategy in option two that I did not have in option one. So you may say, yeah, but you owned your home clear and outright in option one. Yes, that is true, but I also have a ton of equity in my home in year 10 because I've had to pay down that mortgage. The bank requires me to pay down that same amount. So I'm still doing this. I'm still paying that $26,000 every year. So at the end of the day, at the end of year 10, I have $493,333 of equity in my home. So that is compared with, the $1 million that I had here. So you might say, well, I had, double the equity in my home, so I'm better off, but that's not true. You have other assets of $832,000. So your total net worth is over $1.3 million. So that means that by doing option two and investing that excess money in a way that you earned returns that far exceeded in this case, the interest that you're paying on the debt, you have a difference in net worth of almost $300,000. So this is a way that you can really see how putting money to its most efficient use can really help you compound and build net worth in a much more efficient way. Now, you may say that, well, now I don't have to pay any mortgage payments every year. I've got that extra $55,000 that I can invest and make 8% returns now. Whereas, in the fact pattern of option two, you're still making that investment. You're still having to, you're still having to pay the bank that amount, whereas in option one that you're not. But you've got this asset worth $832,000 that is earning returns every year of 8%, as opposed to now you've got, to start that compounding from day one. You're starting to build that asset that you're investing from essentially zero in option one because you weren't investing anything. You were just paying off the debt and very low interest rate debt. So again, if you play this out to all the way to the end of the term of the mortgage, you see that the difference, the gap and the difference in net worth gets even bigger. You would be much higher. You would be much better off in option two. And I will say this is commonly a strategy where you do cash out equity refinancing where every now and then when interest rates are low again, or if they're lower than where your mortgage is today, then a lot of people like to do refinances and pull that equity out of your home. Equity stripping is a great asset protection tool. It's also a great wealth building tool because what I'm going to do personally, I don't own my home, but if I did, I'm not ever paying off too much of that mortgage. I'm going to keep refinancing whenever interest rates are low and I don't have to pay a bunch of money to the bank, and closing costs to do that. I don't, there's no rhyme or reason to how often people do it. Some people do it every 5 or 10 years. It's a very common tool used by real estate investors to do equity stripping or, cash out refis, where you just keep pulling that equity out of the home. And so when you do that strategy, again, this difference in the amount of net worth you're going to be able to accumulate in option 2 is going to just get bigger and bigger and bigger. So again, be careful with this strategy. Again, it's thinking about opportunity cost as an investor. If you can really conceptualize this and understand why this works the way it does and why these examples shake out the way they do, then you are going to be a very sophisticated investor. You're going to be ahead of the game, because investing means understanding how to think about making money, how to invest efficiently, how not to take on too much risk. Again, it sounds great to get 8% returns, but you've got to be investing in something that you feel pretty good about is going to give you 8% on average. You could, of course, get yourself into a lot of trouble if you lose all your money and, lose everything, then that's obviously not a great result. But you should be able to, if you're a sophisticated investor, you should be able to invest your money in a way that you can comfortably and safely get that 8% return or higher every year. And again, remember, the strategy only works if the investment returns you get on average each year exceed the interest rate on the debt for your mortgage. So if you're someone going out and getting a mortgage today when interest rates are, 6% or 7%, then this is probably not the time to do this strategy. You really want to do this strategy when you can lock in that interest rate at a very low rate and then expand the arbitrage between the rate you get on your investment returns and the interest you have to pay over to the bank. So I hope you found this video helpful. If you did, please subscribe to our channel. We have a lot of different videos out there on these types of topics that can really help you understand how to invest your money efficiently, build wealth efficiently, but not take on too much risk or take on, unnecessarily risk that could get yourself in a lot of trouble. So if you like the video, please give the video a like, and again, subscribe to our channel and stay tuned for more content on topics like this.